What we're witnessing in today's housing market isn't just concerning, it's potentially catastrophic. The devastating crash of 2008 that wiped out trillions in American wealth may soon look like a minor hiccup compared to what's brewing beneath the surface today. Data that major financial institutions are deliberately downplaying reveals an unprecedented disconnect between housing prices and economic fundamentals that has created the most dangerous housing market in American history. Even more alarming is what's happening with buyer demand. Mortgage applications have plummeted by over 60% from their pandemic peak, double the decline we saw during the worst of the 2008 crisis. And it's accelerating. In just the last quarter, applications dropped an additional 12%. This isn't a gentle slowdown, it's a market in freefall. The implications for homeowners and investors could be severe, potentially erasing decades of wealth accumulation in a matter of months. Let me walk you through the shocking data and what it means for your financial future. The core issue driving today's housing market toward collapse is an affordability crisis of historic proportions. According to the National Association of Realtors Housing Affordability Index, we've reached the lowest level of affordability in over 40 years of trafficking this metric. The average American now needs a household income exceeding $115,000 to qualify for a mortgage on a median-priced home. To put this in stark context, the median household income in America sits at approximately $75,000. This means the typical American family falls $40,000 short of what's needed to buy an average home, a mathematical impossibility for millions of potential buyers. This affordability gap represents a structural breakdown in the housing market. In the early 1970s, the average home cost about 3 times the median annual income. By 2008, at the height of the last housing bubble, that ratio had climbed to 4.7 times. Today, we're at a staggering 6.8 times annual income, a level that can't be sustained in any rational market. For homeowners who've built wealth through real estate over decades, this has profound implications. The buyer pool for your properties is rapidly shrinking as the next generation simply cannot afford to purchase homes at current valuations. To truly understand the severity of our situation, we need historical context. After analyzing housing data going back to 1890, over 130 years of market cycles, we've discovered something alarming. When adjusting home prices for inflation across this period, current housing valuations sit approximately 80% above the long-term historical norm. This isn't just a bubble. It's the most extreme deviation from historical valuation patterns ever recorded in American housing. For comparison, at the peak of the 2008 housing bubble, prices were approximately 35% above the historical trend line. Today's bubble is more than twice as severe. This 134-year chart reveals a troubling pattern. For more than a century, from 1890 to 1997, home prices remained relatively stable when adjusted for inflation. Then, a significant shift occurred, and we entered an era of extraordinary price growth that made the 2008 bubble appear minor in comparison. Current prices aren't just elevated. They're 80% above the long-term historical average when adjusted for inflation. This represents mathematical evidence that we're experiencing the largest housing bubble in American history. For decades, the Federal Reserve has exercised significant control over housing markets through interest rate manipulation. This time, however, they've lost that control. The 30-year fixed mortgage rate has surged past 7.5%, more than doubling in just 3 years. This isn't merely a temporary spike. It represents a structural shift in bond markets that the Fed appears powerless to counteract. Let's examine the numbers. Since the Fed began raising rates in March 2022, they've increased federal funds rate by approximately 500 basis points. Yet mortgage rates have increased by nearly 450 basis points, creating a nearly one-to-one relationship that defies historical norms. Typically, long-term mortgage rates move at roughly half the pace of the federal funds rate. This anomaly suggests deeper structural problems in the credit markets. The spread between the 10-year Treasury and the 30-year mortgage rate has widened to historically unusual levels, indicating severe stress in the mortgage-backed securities market. For context, during the 2008 crisis, the Fed was able to slash rates from 5.25% to nearly zero, providing significant relief to the housing market. Today, with persistent inflation and a national debt exceeding $35 trillion, the Fed lacks the same flexibility to rescue the housing market. The Fed's balance sheet, which expanded to nearly $9 trillion during the pandemic, is now contracting through quantitative tightening at a rate of approximately $95 billion a month. This liquidity removal is occurring precisely when the housing market is most vulnerable. The early warning signs of this collapse are already visible across the national housing landscape, and they're flashing red with increasing intensity. Nationwide housing inventory has surged 35% year over year across major markets, with some regions seeing their available homes for sale double in just 12 months. This flood of listings coincides with a dramatic slowdown in transaction speed. The average home now sits on the market for 63 days, a staggering 200% increase from the 21-day average we saw in 2022. Desperate sellers are increasingly slashing prices, with approximately 42% of all listings nationwide now featuring price reductions, nearly triple the 15% rate from just 1 year ago. The construction sector is sending equally alarming signals, with builder confidence, as measured by the NAHB Housing Market Index, plummeting to levels typically only witnessed during full-blown recessions. New construction projects are facing unprecedented headwinds, with cancellation rates reaching 30% in some markets, forcing builders to offer extraordinary incentives worth up to 15% of purchase prices just to close deals. Perhaps most telling is the retreat of smart money from the market. Institutional investors, which acquired over 800,000 single-family homes since 2010 and fueled much of the recent price appreciation, have slashed their purchases by a dramatic 70% year over year. These aren't isolated anecdotes or cherry-picked statistics. They're measurable market signals occurring simultaneously at a national scale. The velocity of these changes is particularly alarming. The deterioration that took nearly 2 years to unfold during the 2008 crisis is happening in a matter of months today, suggesting we're witnessing not just a correction, but the early stages of a market in freefall. The housing correction is not occurring uniformly across the country, with regional variations providing a real-time roadmap of how this downturn is likely to cascade through the national market. West Coast cities are leading the decline, as they typically do by 6 to 12 months before national trends follow suit. San Francisco has become the canary of the coal mine, with sales volume plummeting by a staggering 40% year over year, and median prices already falling 15 to 20% from their recent peaks. Seattle tells a similar story, experiencing a 35% sales decline, with desperate sellers offering price reductions averaging 9.7% just to attract reluctant buyers. The once red-hot Sunbelt markets that benefited most from pandemic migration patterns are now showing alarming signs of reversal. Phoenix, perhaps the poster child for speculation-driven growth, has recorded a 35% sales volume collapse, with median prices dropping 10% in just 6 months. Las Vegas presents an even more dramatic picture, with inventory skyrocketing by an incredible 170% year over year as supply overwhelms diminishing demand. Austin, which saw some of the nation's most aggressive price growth during 2020 to 2021, has experienced a sobering 28% decline in median prices from its 2022 peak, erasing nearly 2 years of gains. The Midwest and Northeast, typically more stable regions, are now showing early signs of contagion. Chicago's luxury market has already seen 25% price reductions for properties over $1 million, while Detroit's overall market has contracted, with sales falling 29% amid inventory growth of 45%. Even the historically resilient Northeast shows cracks, with New York's suburban inventory increasing 60% year over year, as remote workers return to urban centers. This regional pattern reveals a clear cascade effect. Western markets implode first, followed by a rapid deterioration in the Sun Belt, with the correction then methodically spreading eastward through the Midwest and ultimately reaching the Northeast, a geographical progression that mirrors precisely what we witnessed in the early stages of the 2008 housing crash, only at a significantly accelerated pace. For investors and homeowners who weathered the 2008 crisis, understanding the structural differences between then and now reveals why today's situation is potentially far more devastating. Unlike 2008, we're facing what economists call a valuation chasm. Current home prices sit at a shocking 80% above historical norms, compared to just 35% during the last housing bubble. This represents trillions in additional overvaluation that must be eliminated through market forces, suggesting potential nationwide price declines of 35 to 45%, more than double what we experienced after 2008. Compounding this problem is today's interest rate trap, a fundamentally different environment than 2008, when mortgage rates declined throughout the crisis, providing relief to the market. Today, we're facing rising rates, with the 30-year fixed mortgage more than doubling in just 3 years. With the average homeowner holding a mortgage below 4% and current rates above 7.5%, there's virtually no incentive to move, creating an unprecedented lock-in effect that freezes mobility and further constrains an already tight market. The demographic tailwinds that eventually helped stabilize housing post-2008 are now blowing in the opposite direction. Instead of millennials entering prime home buying years, we face declining birth rates, population stagnation, and millions of baby boomers preparing to downsize or sell retirement homes. This deteriorating buyer-to-seller ratio is projected to worsen steadily through 2030, creating persistent downward pressure on prices. Adding to these concerns is the institutional investor factor that barely existed in 2008. Large investment firms now own over 800,000 single-family homes nationwide. Their recent 70% reduction in acquisitions, combined with a 25% increase in sales, threatens to flood the market with inventory precisely when demand is weakest. Finally, the pandemic-driven work-from-home trend that fueled the ex-urban housing boom is rapidly unwinding, with 65% of companies now requiring at least a partial return to the office. This creates an entirely new segment of distressed sellers, remote workers who purchased homes in far-flung locations and now facing punishing commutes or job insecurity, forcing them to relocate closer to employment centers. The housing market doesn't exist in isolation. It's deeply interconnected with the broader economy, and the coming correction threatens to trigger cascading failures across multiple sectors that could amplify the initial shock. Regional banks sit directly in the line of fire, collectively holding approximately $3.6 trillion in real estate loans that suddenly look precarious. Even a modest 20% valuation decline would create hundreds of billions in potential losses for these institutions. This banking vulnerability comes at a particularly dangerous moment, with interest rates at their highest level in 16 years and a flat yield curve squeezing profitability throughout the financial system. The construction sector, which represents 3.2% of GDP and employs millions of Americans, has already begun contracting dramatically, with housing starts down 22% year over year. As builders recognize the shifting market reality, historical patterns suggest we could see between 800,000 to 1.2 million construction-related job losses in the coming downturn. Devastation that would ripple through countless communities that became dependent on building activity during the boom. Perhaps most concerning is the potential impact on consumer spending, which drives approximately 70% of the American economy. A 30% decline in home values would erase approximately $12 trillion in household wealth virtually overnight, potentially reducing consumer spending by $600 to $900 billion annually, approximately 3 to 4% of GDP. When housing wealth evaporates, homeowners instinctively reduce spending to compensate for the perceived loss, regardless of whether they plan to sell their homes. This wealth effect works powerfully in both directions, and we're potentially facing the largest negative wealth effect in modern economic history. Are you seeing signs of this housing correction in your local market, or do you believe your area might be insulated from these trends? Share your thoughts in the comments below, and don't forget to subscribe to the channel.